U.S. economist at BNP Paribas, joins me now from New York. The bad news is the good news, and I'm guessing we should look to a Fed moving more slowly at the next meeting.
Well, I'm not so sure they'll be ready to slow down just at the next meeting. Again, as you alluded to in the prior segment, we'll have to watch what the CPI numbers, the inflation report, looks like next week. But we are getting into, for the chess fans out there, the end game for the Federal Reserve, where it looks like they're getting close to being able to say mission accomplished.
Okay. What are you looking for now? What for you are the signs? I mean, if we look at the market will tell us all sorts of things, and it's sort of almost childlike in its way. But economically, what are you looking for?
Well, economically, you mentioned soft landing in the prior segment as well, and I'm a bit concerned that we have a lot of medicine, a great deal of medicine still working its way through the system, and we're not entirely sure how that's going to pan out. And the best example is, for example, in the construction sector, we know what mortgage rates moving from 2.5% at the lows during the pandemic up to 7% is going to do for home sales and whatnot. And we see the volumes of sales rolling over. We see prices starting to move lower. We have not yet seen the layoffs in the construction sector. So it does happen with a very long lag. So we're watching to see how that plays out. And so we see the economy probably slowing below 1% growth by the end of the year. It's a bit like a jumbo jet. If it slows down too much, it really starts to fall out of the sky. And so the risk is that we have to watch these dynamics, the underpinning of the economy, to see how it's performing going into the first half of the year. That other report you mentioned, the services ISM series, that's flashing a recession signal. We saw a manufacturing ISM series earlier this week flashing recession. So I still remain concerned. The Fed thinks it has a bit more work to do, and that will be tipping us into recession around mid-year.
Okay, but why does this employment number remain so strong? Companies, I mean, we see in tech large numbers of layoffs, and companies know that business is going to get tighter and harder. Now, I know 250,000 jobs in an economy the size of the U.S. is relatively small, but why does employment remain strong?
Well, the tech sector is not the U.S. economy, so we on the coast tend to sometimes not pay close enough attention to the manufacturing jobs and the other types of service jobs that account for the vast bulk of employment in this country. So it's a matter of separating Wall Street and Silicon Valley from what we see on Main Street America, and that really explains the difference at the moment. What we see playing out in the labor market is really some labor hoarding that seems to be happening at the moment, as businesses found it so difficult to place employees over the course of 2021 and 2022 that now they're afraid to quickly pivot towards laying off or releasing those employees. We are seeing hints of that, though. If we look at temporary workers, they've been declining for about 5 months running, and the nosedive seems to be intensifying. We heard about big layoffs from Salesforce, from Amazon, from some other large firms. So there seems to be a little bit of a confidence problem evolving among hiring managers that seems to be taking on some additional momentum. So things look good now, but the real question is if it's going to hold up over the course of the next several months.
Now, that's where I was going for my last question, because the market's rallied and less savvy investors watching will think, oh, we're back to the races. But what you're saying, and what I hear again and again, is that the real grind and trudge doesn't happen until Q2 at least.
We are still coming off of some of the stimulus highs of 2022, and most of it has expired, but consumers are still sitting on a very substantial pile of savings that is helping to provide some buffer amid these mounting economic headwinds, but that spending pile is continuing to diminish. So it will be a trial much later this year when hiring managers are less sensitive to these labor hoarding issues, the difficulty placing employees and whatnot. And we see more of a two-sided story on the economics front, whether we're talking about the labor market, inflation, or Federal Reserve policy. And so it is going to be a difficult environment. We can all talk about the good news of inflation coming down, and that certainly is good news for most households. But the other side of the coin, if inflation is coming down, that means compression of corporate margins. That means a more challenging business environment, and that's the type of environment where companies will be willing to cut costs, and that means cut workers as well.
Carl, very glad to have you with us, and of course looking forward to a year ahead where we will talk many times as you help us navigate these choppy waters of the US.